problems in Greece have, to some extent, also helped increase our focus on debt issues here at home and around the world as well. Steve Kroll, managing director at Monness Crespi Hardt, says the U.S. is not a AAA credit. Steve joins us now to discuss the effects of sovereign credit issues on the market. You and your firm advise the top 100 hedge funds and institutions on what to buy and sell. And this is something you told me actually at the end of last year, that you were already concerned about sovereign debt. But why the U.S.? I mean, why is that as much of a concern as what we're looking at over in Europe?
Well, it's clearly not as big a concern as Greece is. But there are 13 or 14 countries that all have the same problem, probably worldwide, that their budget deficits are out of control and the total debt as a percentage of GDP is way too high. I mean, the Wall Street Journal had an article the other day and listed about 15 countries. One was the U.S., obviously Japan, even Germany, which is in fairly good shape. The numbers are just too high. So in listening to your viewer talking about Greece, they talked about giving them a backstop, which is very good, and it's good for the equity markets today. But they didn't talk about the two things you have to do. You have to raise taxes and you have to cut spending to lower the debt. And it's not only for the U.S., which is less of a problem. It's a AAA country, but it has some problems with the debt issues. But the other 12 or 13 other countries still have some serious problems.
That also, Steve, have to be dealt with and dealt with soon.
Of course. I mean, you look at our budget deficit. Now, granted, we're now starting to get out of the start the exit program. But when you have a budget deficit of $1.6 trillion or $1.8 trillion, depending how you want to count it, and your debt to GDP is running about 80%. That is not a AAA credit.
And you have the problems of the states. You know, Carol has been talking with a lot of people about this. The states have obviously a lot of issues that impact that as well.
Of course, of course. So what I'm looking for, which is causing the headwinds to the market, as we talked about in December, that your companies and your consumer really have done a good job in getting their act together in the last year with the financial problem. It's the governments that have taken on the risk now, and they can deal with it, but you deal with it by raising taxes and cutting spending, not doing what we're doing right now, which is the Robin Hood mentality.
You know, Steve, we've talked with Nouriel Roubini just last week. We also talked with Neil Sauce. I mean, they basically equated what's going on in terms of the sovereign debt problems outside the United States, and it's kind of the same as if you put the federal deficit problems here in the United States along with the state, that they're pretty much on par with one another.
Absolutely. I mean, take New York State, which is a classic situation. If they raise taxes and cut the spending, we can get our act together. California, well, they're going to have to do it. I mean,
right.
And then if you take California, which hasn't had an increase in property taxes since 1976 or whenever Prop 13 was passed, if they instituted a 5-year emergency measure, you could balance the budget instantly.
But can they do that in an economy that's still so fragile?
Doesn't make any difference. You have to.
It's a problem for the markets, though. I mean,
well, that's why we said back in December we think we're going to have a rolling correction. The governments right now are under the stress. The consumer is reliquefied a lot, and corporations have done a tremendous job. So the market's going through this constant ebbing and flowing where earnings are pretty good. There's plenty of cash around by investors, yet every day you read, if it's not Greece today, it may be Spain, it may be a state here in the United States or something. So you're getting this constant back and forth, which is making equity markets difficult.
All right, hang on.